You might be thinking Wall Street is smarter and earlier and has more resources than me, so it's always going to be into trades and companies earlier. So by the time I notice anything, it's already too late. But one of the hardest things for people to accept in the markets is this idea that Wall Street is not early. It feels like it should be. It feels like the smartest people, the biggest funds, the most data-driven institutions should always be ahead of the curve. But in reality, Wall Street is almost always late. Not because they're stupid, not because they don't see what's happening, but because they are structurally slow. And once you truly understand that slowness, it becomes one of the biggest advantages an individual investor can have. So let's get into this video today, while you might be better than Wall Street on this move.
Welcome to the game, it's the Instant Stocks by Mikhail Kuhar.
If you don't know who I am, my name is Mikhail. I'm one of the partners at X10 Day Trade. We have developed and built a software over the last 4 years and invested over $1 million to be able to have pro traders step into your brokerage account, not physically in the room with you, but to be able to trade on your behalf. We built a software that you can just switch on and let run. And one of the most important parts about this is you don't actually have to send us money. All the trades we enter and exit through your brokerage account. And why this excites me so damn much, and I'm really excited to look at the results we've been getting. We've been getting on average 8 to 15% returns for our clients. You can see some results here. This is the weekly results. These are some of the results of other people getting their friends involved, putting over 6 figures, and there's hundreds and hundreds of results in here. We've got over 438 members. We've been doing this for over 4 years. So if you've got at least $10,000 to allocate to this, there'll be a link below where you can book in a call. I can walk you through the entire process on what we do on the back end, how we can get you to 8 to 15% returns every single month, and what your account can look like in the next 12 months. Being a part of software and systems like this is one of the big reasons why I've been able to live remotely for the last 8 years. And it aligns with one of my biggest values, which is freedom. And to have freedom, you need two things: time and money. You can't have freedom if you don't have both of those things. So, and most traders spend thousands and thousands of dollars learning through experimentation, through the market, and the market is a savage teacher. So you don't have to do all that yourself. You can actually leverage our team of pro traders. Click the link below. We'll jump on a call. We'll figure all that out. But let's get into the video today. The difference with Wall Street is it doesn't exactly buy stories. It buys certainty, and certainty only exists after something is already working. That single truth explains a lot of confusing behavior in the market, and it explains why institutions almost never buy at the bottom. It explains why they miss early upside, and it explains why stocks like HIMS can feel ignored for long stretches of time, even while the business itself keeps improving. This isn't a flaw in the system. It's how the system is designed. Large institutions are not rewarded for being early. They are rewarded for being right. And being right in their world means waiting. Think about how big funds actually operate. They're not managing thousands of dollars. They're managing billions, and they have mandates, they have risks, they have committees, lots of red tape to cut through. They have compliance rules. They have position limits. They can't just wake up one morning and say, "This looks interesting, let's buy it." They need proof, they need consistency, and they need predictability in what they're going to do. And most importantly, they need something that can be modeled now. Look at HIMS. In its earlier years, through that lens, small revenue base, one geography, limited products, and even loss making. Even if a portfolio manager believed in the long-term vision, the fund just couldn't act in size and quick enough, not because they didn't want to, because they weren't allowed to. So what do institutions do instead? They wait. They wait for international expansion, they wait for proof, and while they wait, companies like HIMS keep executing quietly, quarter by quarter, and this is why stocks like this often feel invisible. Not because nobody sees them, but because the biggest buyers are standing on the sidelines, watching. It's like watching a house being built. You know, the banks wait until the final expansion, and they pay throughout certain progresses and when the structure's in place. The structure might already be solid, the wall's already up, the plumbing might be done, but until the paperwork clears, the money doesn't move. So what actually changes that? Scale. There are moments in a company's life where something flips, not emotionally, but structurally. And for HIMS, those movements are starting to stack up. Revenue moving past $1 billion, subscribers crossing into the millions, margins improving, unit economics stabilizing. And now with international expansion entering the picture, these aren't cosmetic milestones. They are permission slips. They allow institutions to say, okay, now we can model this, and now we can enter this, and now these companies are investable companies. Once a business becomes modelable, long-term capital starts paying attention. Not hedge funds, chasing momentum, not traders flipping charts, but endorsements, long-term funds, the kind of capital that doesn't leave quickly. A lot of people can get this wrong with institutions. They don't move fast. They don't show up one day and then they buy 10% of a company. They enter slowly and they initiate small positions. They watch, they execute, and they add over time. They build exposure quarter after quarter. That buying pressure is actually quiet, but it's persistent. And persistent buying does something very specific to a stock. It raises the floor. Pullback, stop going as deep. Volatility compresses. Bad news starts to matter less. That's usually the sign a stock is transitioning from being traded to being owned. Now connect this back to HIMS. As the business scale, the risk profile changes, and it's not eliminated, but it's reduced drastically. And that distinction matters. Institutions don't need perfection. They need bounded risk. HIMS didn't suddenly become flawless, but it became understandable, predictable, and repeatable. And that's enough. This is where the delay becomes important because institutions don't buy potential, they buy confirmation. And confirmation is really expensive. It costs time, it costs patience, and it costs price appreciation. And by the time institutions feel comfortable, the easy upside is already gone. That doesn't mean the stock can't go higher later. It just means the best risk adjusted opportunity exists earlier. When uncertainty is still present but shrinking, this is why patient investors often outperform professionals over a long period of time. Not because they're smarter, but because they're allowed to be early. Wall Street is constrained by rules. Retail investors are constrained by emotions. And if you can control your emotions and you can exploit structural delays, that's the real edge. Think about it like this. Institutions are like cargo ships, massive, powerful, slow to turn. Retail investors are more like speedboats. They're small, agile, and easily knocked off course. Most retail investors crash because they panic, and they're also reactive. Most institutions arrive late because they can't turn quickly. If you can combine retail flexibility with institutional patience, that's playing the long game. That's playing a very different game. This is why stocks like HIMS often feel boring right before they don't. The business keeps improving, but the stock doesn't respond until one day it does. And by that time that happens, the narrative has already changed. Analysts start upgrading funds and disclosing positions. The stock suddenly feels obvious. It's never looked this way before from the beginning, but now it is. That's the middle. When large capital moves slowly in one direction for years, it doesn't look exciting day to day. But what happens in hindsight is it looks inevitable, and inevitability is what long-term winners are made of. That's why understanding why Wall Street is late matters so much. It keeps you calm when nothing else is happening. It keeps you patient when price lags progress, and it helps you recognize when boredom is actually the signal, because the market doesn't reward excitement. The market rewards endurance, and the biggest returns often come from holding through the phase where nothing feels special until suddenly everyone agrees, and by then the easy part is already over. Where if you've ever owned your business before, you can jump up, change the branding, change the mission statement, you can change everything, you can change the service you deliver at a very fast pace. And that is what I'm speaking to in this video. If you enjoyed this video, subscribe. Let me know below what you're most excited about in seeing HIMS roll out in the next 12 months. If you're looking for more content around HIMS, I'm making videos daily, walking you through exactly what I'm looking at and what to look forward to and what to watch out for in this journey in investing with HIMS. As always, my name is Mikkel. I'll see you in the next video.